A few weeks ago, I was watching YouTube and I came across a super interesting video that was offering this creator's take on whether you should pay off your mortgage early or not. And here's what the creator said. You should pay off your house as fast as you possibly can, but you should always have the largest possible mortgage right up until the day that you die. And frankly, that caught my attention because it goes against the conventional wisdom, right? I'm going to say it again. You should pay off your house as fast as you possibly can, but you should always have the largest possible mortgage right up until the day that you die. And then he went on and he used a really interesting analogy. And he basically said, let's imagine that this glass is your house and your house is worth $500,000. So right now you have an asset of $500,000. And then he also said, let's assume that this picture is your bank account. So we're just looking at the picture now. And the picture is your bank, and the water in it is your account balance, and it's $500,000. And so his question was, should you take the money from the bank and should you pay off your house? It's an interesting question. It's an interesting analogy. His thumbnail had it. You can see I borrowed that idea, but let's do it again, right? But this time I want to take a step back, and he's right, and his math is right, and this analogy is great. So this is your house. It's worth $500,000, and you have a mortgage on it for $500,000. And so the question is, what is your net worth? Well, your net worth is the value of all of your assets minus your liabilities. So in this case, we have a $500,000 house on the asset side. We've got $500,000 in the bank. Remember, the picture is the bank, and the water is how much money your bank account has in it. So you've got $500,000 in the bank. You've got a $500,000 mortgage. So the value of your assets is $1 million. And what's your liabilities? Your liability is the mortgage that you have on your house. He's using the glass as an analogy for his house. So you have $500,000 house, $500,000 in the bank, and you owe a $500,000 mortgage. So what's your net worth? Your net worth is $500,000. And he would argue that in this case, you've got $1 million worth of assets. Your net worth, either case, is $500,000, right? $500,000 home, $500,000 mortgage on it, and then $500,000 of water, of cash in the bank. So your net worth is your assets, $1 million less your $500,000 mortgage. Now he says, let's say we take this money in the bank and we pay off our house. So how much money do we have in the bank now? We have zero money in the bank, right? We've drained all the water, all the cash out of it. And what's the value of our assets? Well, we own one house, and the value of that asset is $500,000. So our net worth is $500,000, which is our only asset now is our house. But now there's no mortgage on it, so we have no liability. So our net worth is still $500,000. And so he goes and then argues that, you know, because of that, you want to have as many assets as possible working for you. And he goes through and he shares, you know, a $500,000 mortgage, and all of his math is correct here, a $500,000 mortgage. You're going to pay 6%. He used the example of 6%, which is fine. A 30-year mortgage. And over that period of time, if you borrowed $500,000, you're going to pay back in total a little over $1 million. But instead, what he argues is, instead of taking this cash and using it to pay off the house, what he's saying is don't pay off the house. Keep the money in the bank, keep the money in your investment account, and now you have $500,000 that you can invest. And when you do the math on the $500,000 at 6%, over 30 years, and again, his math is right, you have just under $3 million. So his argument is, if you keep the mortgage, you're going to pay back $1 million over 30 years. And if you keep the assets, you're going to make $3 million. So why would anybody ever pay back their house? So that's his premise. And my channel is not about pointing out flaws in other people's arguments. That's not what this is about. Myself, and I believe this other creator's goal is to help as many people as possible. But we have different opinions. And that's what I want to share with you is my opinion on this, which is I think that could be dangerous. You know, if you're 20 or 30 years old, a strategy like that, saying keep as big of a mortgage as you possibly can, it's essentially leverage, right? And leverage is just borrowing money from the bank. So why do I not like this idea? And again, the math that this creator put out in his YouTube video is solid. But let me ask you a question. You know, most of my viewers are 40, 50, 60, kind of in that range. If you had a chance, so your house is paid off, and somebody said, you know, I'm going to give you a loan so you could invest money. And you've got to, in order to break even, you've got to get at least 6% on that money. Would you do that? You know, some people, some of my viewers, actually probably a lot of you, are in a great situation where you have a fixed rate loan at 2.5% or 3%. And you know what? It's kind of hard to not do better than that over time. You could, right? I mean, you could do worse. The stock market could go down. But to answer this creator's question, the reason that I wouldn't do that, and this is not financial advice for you, you need to hear both ends of that argument. And so hopefully you understand what that other creator was saying is that leverage is going to work in your favor. And again, his math is right. If you keep a mortgage, you're going to pay $1 million. And if instead you invest that money at 6%, in theory, over 30 years, you're going to have $3 million. So why don't you do that? You don't do that because you could lose, right? Once you've paid off that house, that's a wonderful thing. And he even acknowledges that, you know, the reason that you would say not to do it is because you don't like having a mortgage. I would argue you don't like putting your financial security at risk. And when you invest that money, you could lose. So that's another reason to do it. And the other thing I would say is you only have to win once in your life. That's the nice thing about saving and investing for retirement. You only have to win once. Once you have enough money to retire, you've now won. You have to take that leap into retirement, and I talk a lot about that on my channel, right? Where if you're 60 years old, you likely only have 1,000 weeks left of healthy, active time. So you have to have the courage to take that leap. But once you've become financially independent, once you don't have a mortgage, and now that you can no longer get mortgages, at least at the current time, for 2.5% or 3%, the going rate right now is right about 7%. Why would you risk something that probably doesn't matter? Why would you risk something that matters a lot, which is your financial freedom? Why would you risk your financial freedom to gain something that maybe doesn't matter a whole lot? So that's the question. Again, you've got your house, you've got money in the bank. The question is, do you pay off your house? And Azul would argue, yes, please pay off your house, sleep well at night. Don't put at risk what you've worked so long and so hard to achieve. And the other thing I want you to do is don't put at risk, once you've gotten there, don't put it at risk by not making the leap if you want to make the leap into retirement. And that's what this video up here is all about. 5 reasons to retire as soon as you can. Thanks for watching this one. Bye-bye.